Live from New York City this morning. Good morning, good morning. For our audience worldwide, equity futures trying to bounce here from a 4-day losing streak on the S&P 500. Futures down 0.5%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York, coming up, the U.S. labor market is looking even more resilient. Secretary Yellen says the global outlook is improving, and nobody at the Federal Reserve wants to stop hiking. We begin with the big issue, looking to bounce back from the longest losing streak of 23.
Stocks had a big move up to start the year. They've given some of that back.
We're in this sort of uncertain environment.
There are risks.
Recession risks.
Recession risks.
Recession talk.
The geopolitics at the moment still looks pretty difficult.
Geopolitical risk. That geopolitical risk is higher now than it has been for many, many years.
We still have a high inflation environment.
Inflation remaining stubbornly higher than what the Fed wants.
Stocks have got ahead of themselves.
The downside risk is higher than the upside risk.
It's going to be pretty painful.
The inklings of a broader slowdown is something to pay attention to.
Something to talk about right now. Alpine's Sarah Hunt and Troy Gayeski of FS Investments with us this morning. Great to have you both with us. And Sarah, I want to start with you. The last time you and I spoke, you said there was upside risk to this equity market. That could be the pain trade. Is that still the case?
I think that was a little bit earlier in January. So I'm going to say I think that we've already had that upside in that pain trade. And I think what you're seeing now is reality coming up against the fact that the data is, in fact, getting a little bit more supportive of a stronger Fed. And the equity markets, that's going to be tough for them. And they've already had a fairly large move. I mean, the NASDAQ is still up 9% or over 9%, close to 10% year to date. And the S&P is up close to 4 or 5. So I'm not sure that we're seeing a pain trade higher now. I think we're going to see a lot of uncertainty and a lot of swings around big data points.
Adding some more weight to that move this morning, that's for sure. Up 0.5% on the S&P, up about 1% on the NASDAQ. Keith Lerner of Truist was on the program earlier this week. He said bad news was bad news, good news was bad news. Troy, do you agree with that?
Yeah, I think when you get markets priced to perfection, we had another very strong bear market rally, driven first by short covering, and then, of course, gamma trading, and then CTAs and trend followers flipping bearish positions to at least neutral. And then eventually you suck in people to the more perma-bullish argument. And then you got equities back up to 18.2 times forward earnings. And then, wouldn't you know it, John, yet again, the economy stays incredibly resilient, led by the labor market. The talk of the Fed hiking more aggressively comes back, even doing more balance sheet drainage. And 18.2 times forward earnings is not cheap unless you're referring to the era of QE asset inflation, and those days are over.
Those days are over. Based on the Fed minutes yesterday, I'm not sure what we learned. Sarah, I went through them. Chairman Powell said in the news conference 11 times, according to Mohamed El-Erian, the word disinflation. And then we all opened up the PDF and tried to find the word disinflation and couldn't find it. Sarah, what's that about?
That's an interesting question to which I really do not know the answer. I read those minutes too and felt the same way. They also didn't talk about pausing, except as somebody mentioned yesterday on Bloomberg, that it was a pause outside of the U.S. I think that there is a real question here about what's going on with the data and whether or not some of the strong readings in January were seasonal and whether some of the weaker readings in December and November were really what's going on. And I think that that's just going to keep happening data point by data point. And as you saw this morning, you saw stronger numbers on the inflation side, and the labor market is still very strong. Now, the Fed has hiked very quickly, relatively speaking, to history. So we're not sure when those, long and variable lags actually come in here. But if we don't have some sort of a reaction, I think the Fed is going to keep raising rates given the backdrop and the data that we're seeing right now.
Claims this morning, 192. We were looking for 200K. We dropped from 195. Core PCE, quarter on quarter, 4.3%. We were looking for 3.9%. Now, Troy, in January, we had some fantastic data reported in February. I mentioned this earlier this morning. Economists were lining up to say there might be more noise than signal in that data. Based on what you've seen in the last week or so, do you think there might be more signal than noise?
Yeah, I think that's definitely the direction the argument's heading now. And look, there were good reasons to think that January was a one-off in terms of warmer weather, particularly on the East. And That being said, I mean, every data point recently has come out reinforces the argument that the labor market remains incredibly resilient. And as long as that's the case, consumers will have the ability to keep the economy going and keep inflation much higher than the Fed is comfortable with, which again means tighter monetary policy, more balance sheet drainage, more financial asset pain. But it sure beats a recession, John. That's the silver lining here, right? There are many silver linings, but one of the key is that, you know, the labor market continues to do extremely well. Nominal GDP is still strong. It's just finally financial assets that are bearing the brunt of a dramatic Fed policy shift.
Troy, well said. If you'd said 12 months ago, and we were talking with Matt Lazzetti at Deutsche Bank about this morning, that the Fed could get somewhere close to 5% and unemployment would still be at 3.4, and Mike McKee claims would be at 200K. Mike McKee, the data this morning, impressive.
You know, it reminds me of one of those Jamie Lee Curtis slasher movies where she's walking around and the music is up and she opens the closet and you're expecting somebody to jump out and nobody ever jumps out yet. We're waiting for that with the jobless claims. 194,000. The expectation was for 200, and that is extremely low. Look at this chart here. Claims always go up before a recession. So if we're going to have a recession, we are not getting there. I left out the 2020 recession because the distortion was so great with the jobless claims, but every other time, and we're not seeing that. So what's going on? Well, in the minutes yesterday, the Fed did discuss it on February 1st and how low they were, and they said that some contacts appeared keen to retain workers because of their recent experiences of labor shortages and hiring challenges. We've talked about labor hoarding, and that does seem to be going on. They also worried about the inflation numbers. Of course, they didn't have the same numbers that we have today, but a number of participants observing that a policy stance that proved insufficiently restrictive could halt recent progress in moderating inflationary pressures. That appears to be what's happening. We got that number today, the core PCE quarter-over-quarter number higher than it was in the prior quarter, in the first number rather, 4.3%. And you can see the forecast for tomorrow. We're expecting the January PCE inflation numbers to rise significantly the way the CPI did and tell us we still have an inflation problem.
Mike, can we talk about leadership at the Federal Reserve as well? I'm sure you saw that report from the Wall Street Journal yesterday. The White House mulling 2 economists from the Obama administration as candidates to become Boehner's successor as vice chair. What do we know about them?
Well, Janice Eberly is an associate dean at the Kellogg School of Business at Northwestern University, and Karen Dinan is at the Harvard Kennedy School. Both were the chief economist at the Treasury Department during the Obama administration. Dinan followed Eberly in the role. Dinan spent 16 years at the Federal Reserve before going to Treasury. Eberly, basically an academic, was at MIT and Wharton before she went to Northwestern. So they're well known on the circuit. They're well-respected economists, probably not a lot of difference between the two. This report yesterday, or the journal report based on an ISI report that they are under consideration, plus Seth Carpenter, who is at Morgan Stanley. So the administration deep into the search for someone to replace Lael Brainerd right now.
We'll keep asking Seth about that. I'm not sure he's going to reply anytime soon. Mike, are we going to go through all their previous work and make calls about whether they're doves or hawks before they're even nominated to be vice chair?
We are not, but I'm sure people are. There'll be a lot of questions about how they match up with Lael Brainerd because she was seen as something of a dove, counterweight to the more hawkish members of the committee and someone who sort of focused on the impact of monetary policy on the average person, the average worker. And so I'm sure members of the Senate who are going to be considering this will be wanting to know which one of them, whoever is chosen, what their views in that area are.
Mike McKee, thank you, sir. As always, Troy, I want to come to you on just how high the bar is, do you think, for a 50 basis point move from this Federal Reserve?
Yeah, right now it's pretty high. I mean, obviously we're trending in that direction as every data point comes out. But, you know, once you downshift from 75 to 50 and 25, you know, it takes quite a bit of political will to move that back up to 50 basis points. And obviously that's been a trial balloon so far that's been floated. But if we continue to see strong data between now and March, that's now entirely possible. And then, you know, more to the points we've talked about in the past, I mean, you're now talking about 5.5% peak rates, if not higher. And that's going to be held there for quarters and quarters, not months and months, unless there's a material degradation in the labor market. And to your point before, there's just no evidence, and no one would have guessed that 12 months ago. If you had said to anybody that we're going to have this degree of tightening, this much weakness of growth overseas, this big a drop in the housing market, no one would predict claims to be under 200K.
I couldn't agree more. So when you look across the curve and you're now thinking about quarters and not months,
yes,
where do you want to be? I can get 5% on 6 months. I can get a 2-year at 470, a 10-year at 395. Where would you want to sit with that in mind?
Yeah, so if you have to take directional duration risk, you certainly want to favor the short end of the curve, right? You're just not getting compensated enough at the far end of the curve for what we expect to be, continued at least short-term pressure in the back end. But more directly, John, what we favor right now are yield curve steepener positions where you're not taking directional duration risk, and you also have very asymmetric risk reward based on history about how much more inverted the yield curve can possibly get from here, because we're right around 75 basis points. It's unlikely we go to 130 or 150, but we could certainly go to 100 or 105. And over time, and by time we mean the next several years, you should have a curve that normalizes, at least goes to flat, and then potentially re-steepens to 120 to 150. We think that's a much better way of playing a normalization between nominal GDP and real GDP than being long equities at 18 times forward earnings or being very long speculative credit at 350 to 400 over.
That's the challenge, Sarah. The challenge from the bond market to the equity market. I understand the income argument. Sarah, how do you anticipate the bond market's going to correlate with equities going forward from here?
Been so all over the map that it really has been a difficult thing because historical correlations haven't really worked very well. And if you think about the fact that the unusual situation of coming out of pandemic has made all of these data points very unusual, including the labor market. I mean, if you just think about the fact that Home Depot and Walmart are talking about paying more, even in a strong labor environment where other people are letting people go, it tells you that there is some real strength there. And I think that, we favor the short end for clients right now because 5% is very attractive in the near term while you see what happens in the equity markets, right? So you want to see some sort of a balance. But I am sort of amazed at the equity markets at 18.2 times with the short end of the bond yields right now where they are. It just seems like there is an imbalance, and it's, who's right, credit or equities? And generally speaking, credit tends to get it right more than equities do, but we'll have to see how that plays out going forward.
Sarah, there's been plenty of surprises the first few months of 2023. One of the surprises has been the leadership from tech. Now, maybe looking at positioning alone, maybe that wasn't a surprise for a lot of people, given how they performed in the last 12 months. The leadership last year and the year before came from energy. Sarah, you like that part of this equity market. Do you still like it?
I still like that part of the equity market. There's some really up and down situations that are going on with commodities, particularly natural gas right now, especially in the United States. And certainly this very warm winter has made what is normally a weather-driven trade, or at least has a weather component, one that has really not had much of a weather component. And I think that Europe was very lucky in the fact that we had a mild winter because they had some real challenges, and they're going to have some real issues going into next year. So there will definitely be some volatility there, but longer term, we do think that there is some legs in this energy situation, especially because you've had several years of a lack of investment. And I don't think that we run the tail out on hydrocarbons quite as quickly as politically we seem to be talking about doing.
Well, you mentioned Europe. They've got a problem with core CPI as well. Record high. Euro dollar this morning at 106.10. Saw a 105 handle yesterday and today for the first time since the early part of 23, the first week of January. Troy, I wanted to talk to you about real estate as well, both commercial and residential. Looking at housing prices dropping from a peak last May. This is a median US home sale price of 433 last May, 383,000 last month. That's residential. Let's talk commercial. There was one story in the last 24 hours that I'd love your response to, Troy. It was an office landlord controlled by PIMCO defaulting on about $1.7 billion of mortgage notes across 7 buildings. The buildings, San Francisco, New York, Boston, Jersey City, New Jersey, owned by Columbia Property Trust. Troy, what's your read on what's happened there, and how would you like to take exposure or not across that sector?
Yeah, so we'll start with residential. It was really no surprise that after a 35 to 42% surge in home prices, as mortgage rates moved up so dramatically, affordability got back originally to the record lows of 06 and then dropped even further, that the housing market finally peaked. And, when you look at where mortgage rates are and affordability versus income now, nothing like a GFC 35, 40% peak to trough, but probably a 20 to 25% peak to trough. So there you want to favor cash flows that benefit from home price declines. particularly interest-only securities, and not take residential credit risk, which is very different than most of the post-GFC period where that was so attractive. Now, moving over to commercial, there's no doubt that you want to be in the senior part of the capital structure right now. There's much more price downside to come in certain sectors. Ultimately, you're getting a better yield in senior mortgages than you are cap rates. So you got to be on the top of the capital structure. And then in terms of major metro office, look, the best framework to think about this is it's going to be a repeat of the slow motion train wreck that we had in bricks and mortar retail from really 2011 through 2021. And there's finally light at the tunnel. This is going to be a multi-year valuation adjustment. And, it's really hard to repurpose major metro office into multifamily. It takes tremendous capital investment, and it's going to require some public-private partnership. So we're going to see those losses bleed out, over the next, 5, 7, 10 years to primarily equity holders, where many will be wiped out, but they will leak into debt to some extent. So, when you're thinking of lending strategies, you just want to make sure that you don't have an overabundance of exposure to major metro office, Seattle, San Francisco, Chicago, New York, and DC as well, because the federal government's shrinking their footprint there.
Troy, you know what happens? People mention real estate and their mind goes back to what happened in 07, 08. Yeah. Are you saying that ultimately then this is going to be something that plays out over a long period of time, not all at once with a big bang?
Yeah, so the difference now, right, is we don't expect nearly the same degree of price declines for a variety of reasons. Two, the banking system is just so much better capitalized. We have 50% more Tier 1 capital. We have over $3 trillion of excess reserves still. So there's tremendous loss absorption capacity. And then equally important, underwriting standards prior to the GFC and, from really 04 to 06 completely collapsed. And they stayed incredibly tight this entire cycle. So you didn't see the rather poor underwriting in both commercial and residential real estate. So we think this is more of a valuation adjustment, a healthy adjustment, where there will be losses taken in the equity part of the capital structure, but the vast majority of debt securities should be relatively safe. That being said, if you look at Ginnie in particular in the agency market, they were doing higher LTV loans, so there could be some losses at Ginnie, but they should be manageable.
Hey, Troy, appreciate it. As always, Troy's perspective on what's happening there. Troy Gersky alongside Sarah Hunt. To the both of you, thank you. Your equity market pushing a little bit higher, bouncing back from 4 days of losses on the S&P, up right now by 0.7%. The Nasdaq up more so. Let's get some individual movers. We can do that with Abby. Hey, Abby.
Hey, John. Well, one reason that we do have that Nasdaq popping higher, outperforming the best day since last Monday, all about Nvidia. This move is stunning to the upside for the chip maker. It's up about, at this point, really at pre-market session highs, up nearly 13%. It's all about the forecast. They put up a good quarter, too, beating top and bottom line estimates. But for this current quarter, they are forecasting $6.5 billion versus the estimate of $6.35 billion. And it has everything to do with their bet on AI processors. As for other earnings movers, eBay and Alibaba, well, eBay, there was a small beat. The outlook disappointing. So you can see those shares are down 5.5%, also given the drop in active users. This is the 7th quarterly drop in a row. And then Alibaba, a big adjusted earnings beat. John, this is amazing. They put up $19.26 in earnings on a single quarter, about 16% better than the estimate. It seems as though Alibaba and China Tech popping on the day.
Abby, thank you. Want to watch into the opening bell coming up. Secretary Yellen striking an optimistic tone.
It's fair to say that the global economy is in a better place today than many predicted just a few months ago.
That conversation up next.
It's fair to say that the global economy is in a better place today than many predicted just a few months ago. In the fall, many were worried about a sharp economic slowdown across the world. The challenges we face are real, and the future is always uncertain. But the outlook has improved since we gathered in the fall.
Secretary Yellen there, delivering remarks at the G20 finance meeting over in India, sounding optimistic over the economy while reiterating calls to support Ukraine.
We will stand with Ukraine in its fight for as long as it takes. We commend our allies for stepping up their direct assistance. We have made clear that providing material support to Russia or assistance with any type of systemic sanctions evasion would be a very serious concern to us.
The secretary also warning countries about helping Russia evade sanctions. This as Bloomberg finds millions of barrels of sanctioned Russian crude are being switched between shippers in the middle of the ocean. Team coverage starts right now with Emily Wilkins in D.C., Julian Lee over in London. Morning, Emily.
Good morning, John. Well, definitely, Secretary Yellen was able to not only go and say that she has a better outlook right now for the global economy, but also show that the U.S. is having the really resilient domestic economy and showing that the U.S. right now, they've been able to keep the job market high. They've been able to keep things going. At the same point, there definitely is a concern, a continuing concern about Russian sanctions, Russian oil. We do have Congress looking at various bills to try and help the U.S. be energy independent. One of those, if you remember, it's that permitting reform from Senator Joe Manchin. He's back talking with Republicans about it. He's hoping that that would expedite the ability to do the drilling and to get more fuel into the U.S. economy.
Julian Lee, I wanted to draw people's attention to the story you've put together on these Russian barrels of crude. Julian, just walk us through what you found.
Yeah, well, I mean, there's the Bay of Lakonikos off the southern Peloponnese in Greece. It's always been a popular area for transferring cargoes from one ship to another. It's relatively sheltered. And what we've seen this year so far is about 20 transfers of cargoes of Russian crude. More than that, or additional to that, transfers of refined products as well. It's not clear that this is particularly sanctions evasion because we're able to see it happening.
True.
But one thing that's very clear is the Spanish government has taken a very tough line on this of similar transfers off their North African territory. Greece is letting this go at the moment and doesn't seem to be wading in.
Amazing story. Julian, thanks for it. Fantastic read. Julian Lee there, Emily Wilkins. Up next, your morning calls. Let's get you some morning calls. First up, Morgan Stanley upgrading Intel to equal weight, seeing limited downside after cutting its dividend. BofA downgrading Lucid to neutral, seeing signs of weakening demand. And finally, Truist raising its price target on Etsy to 150, calling the company's forecast appropriately conservative. That stock is up by 3.8%. Coming up, gearing up for what Jonathan Golub of Credit Suisse calls stagflation light. That conversation up next with futures rebounding. We're up 0.7%. The opening bell up next. 24 seconds away from the opening bow this morning. Good morning to you all. Going into that open, futures positive by 0.75% on the S&P, on the Nasdaq up by 1.28%. We'll talk about Nvidia, the why behind that move, in just a moment. 4-day losing streak on the S&P, looking to bounce back from that at the opening bow. There's the opening bow. Switch at the board and get to the bond market. Yields bouncing off the back of jobless claims coming in below expectations. A downside surprise. That's what we call the right kind of downside surprise. Yields fade from 395 at the high, 396, 397-ish, 392.54 right now on a 10-year, up by not even a basis point. In the FX market, euro-dollar from 105 to 106, positive not even 1/10%. Core CPI in the Eurozone, record high, and crude looking to bounce back as well, 75.50 on WTI. We're positive there by about 2%. 25 seconds into the session, equities look like this on the S&P, up 0.75% on the Nasdaq, up by 1.1%. Consumer discretionary year to date absolutely flying on the S&P 500, up by about 13%. Online retailers eBay, Etsy, Wayfair, all reporting earnings this morning, delivering a mixed bag of results amid a challenging macro environment. Abby has more.
Hey, John. Well, this is interesting because we do have on the day the consumer discretionary space actually flat, and it has to do with some of that declining action from specifically eBay and Wayfair. So it was a bit of a mixed bag here relative to eBay. They put up a small beat, but the outlook disappointed, and they also had declining users. Now, relative to Wayfair, down 8%. On the year, up 50%, though. So the quarter was priced to perfection. It didn't come in that way, a wider loss. They also saw a decline, 19% decline on a quarter-over-quarter basis in users. Now, relative to Etsy, a bit of a more positive view there. Mixed quarter, they beat sales. Profits were down, though. Analysts liked it. Price targets raised. And you can see there the sales growth for Etsy, impressive, up 13%. But for Wayfair and eBay, not so much. And relative to those declining user bases, eBay, their declining user base has been over the last 7 quarters in a row. But they've also, for the last several fourth quarters of each year, they've seen a decline. And that's the big December quarter. So it seems as though eBay are folks, consumers, users relying on eBay less during that all-important holiday quarter.
eBay down 5%. Abby, thanks for that. You want to move? Here's a move. Nvidia at more than 12% in the early part of the session, giving an upbeat forecast with its push into AI, helping to offset weakening PC demand. The CEO saying this: it's a wake-up moment for the capabilities of AI. This is really where we can be of great value for the industry. Isabel Lee has more. Hey, Isabel.
Hi, John. It's really all about guidance when it comes to earnings, and investors are rewarding Nvidia for that. The company gave a bullish outlook for the first quarter on the back of a strong AI push that it said would offset the sluggish demand in personal computer chips. So Nvidia said that it expects first quarter sales to hit $6.5 billion. That's more than the fourth quarter and slightly above consensus. Obviously, Wall Street is cheering the forecast despite overall revenue declining 21%. As you can see on the chart, it's the second decline in 13 quarters. Still, shares are jumping today, and it's already the best performer year to date, with the S&P Tech Index just slightly behind Meta. And perhaps to the point you made earlier, it's helped by the recent AI view. We have the CEO and co-founder Jensen Huang saying that, interest in ChatGPT has opened the eyes of business leaders to the power of artificial intelligence. And if you're wondering why the holiday season didn't do so well, it's because gaming fell by around 46%, but it did top earnings estimates average still, though. John.
Isabel, thank you. What a move year to date and on the session as well. And worth considering, it is the fourth biggest weighting on the Nasdaq 100. That's behind much of the move we're seeing this morning. About 3 minutes into the session on the S&P, we're up by 0.8%. The broader Nasdaq composite up by 1.1% on the Nasdaq. Let's stick with tech. Shares of Alibaba surging after delivering better than expected results. The company's CEO expecting China's reopening to fuel near-term growth, saying this: all of our merchants expressed a strong desire to get back to business. We expect that this recovery will continue. Everything is now quickly getting back on track. Katie Greifer with us with more. Hey, Katie.
Hey, John. Well, we're already seeing a recovery on the earnings front. If you look at profits, there was a big beat there. That measure surged about 69% to about $6.8 billion. And of course, that's partly thanks to cost-cutting measures. We got that in the form of layoffs last year to the tune of about 19,000 jobs. Now, those were designed to boost, quote, high-quality growth last year, and that continues to be the focus for Alibaba. They're prioritizing profitability rather than new business expansion. And today's rally, we're talking about 3.5% right now. It's helping to further rebuild Alibaba's market cap. Now, since October's low, Alibaba has added about $84 billion back to its value, which currently clocks in at about $250 billion. And as you can see, that rebound is dwarfed by Tencent, but still comfortably ahead of rivals such as Pinduoduo, such as you can see Baidu there as well. And that's the case even with Alibaba's relatively rough month. Again, we have shares up in a big way from October, up about 50% from that low, but that gain was about 90% at its peak. And it's worth noting that Alibaba is still down about 10% over the last year, John, so a bit of a hole there.
It's funny, I picked up the exact same chart as Katie. Katie, thank you for that. So off that October low, we're still up by about 54%. Including today's move. But to Katie's point, the high at the end of January, we were off that low by something like 91%, just a phenomenal move. For the broader market then, 5 minutes in, we do get a bounce. We snapped the 4-day losing streak, at least for now, on the S&P up 0.7%. Here's the take from Jonathan Golub at Credit Suisse. This is what he has to say. The best way to describe this environment is stagflation light. I'll get to that term in a moment. 3 to 4% inflation with slow growth but abundant jobs. It looks nothing like the 70s, but it's a challenge for equities. Jonathan Golub, I'm pleased to say, joins us right now. So, John, let's go there. Stagflation light. I see great growth right now. What do you see in the future?
Well, if you look at the consensus based on the Bloomberg survey of economists, we're looking at 60 basis points of GDP this year. And next year it gets a little bit better, but not a lot. And there's two things that are dragging on the economy. The first one is if you're a business that wants to expand, you can't find workers. And that's a headache. And the second one is that the Fed is tightening enough to really slow down the economy and take some air out of the tires, but not enough to throw us into recession. Now, John, last time that you and I talked, we said, what would guys like me want to see more than anything else? You crash the economy, you have a real recession, you have a big V-shaped bounce, and it's a cycle that we know exactly how to think about. This is much more challenging.
Well, talk to me about what that means for discretionary. That's the winner year to date, 13% year to date on the S&P. How do you think about that, John, at the moment? Up 13%. Yeah. If we go to your world of 3 to 4% inflation, slow growth but abundant jobs, where does that leave discretionary?
It's actually my favorite sector for this type of environment. Just think about what the consumer is facing. Last year, wages went up 3 to 4%, but inflation, CPI averaged 8%. So the average American went to the store, got a raise, and realized it didn't go as far as he wanted. This year, he's getting a raise of 5 to 6%. If you're a retiree, your cost of living adjustment on your Social Security or government pension is up 8%. But inflation is expected to be under 3% at the end of the year. So the consumer is going to feel surprisingly empowered in this environment because wages are running hotter than inflation, or they will be throughout the course of the year. The other thing is, with jobs abundant, you have this really golden environment for consumers. It's one of the reasons why that both the University of Michigan and the Conference Board consumer confidence surveys have been rising steadily since last June, because last year was really a year where companies won over labor. And this year is one where labor wins out over corporate profits and companies. So there's a real shift in the in how things are playing through.
Well, John, let's talk about the winners and the losers around that story. The airlines year to date, American Airlines up 22%, United up 32%, Delta up by close to 15%, 14% higher. Do you see reasons for that to continue?
Well, first of all, as I said, I think the consumer will increasingly have more discretionary income. A lot of people are talking about the need for consumers to tap their credit cards and how much further can that go. But the real issue here is that wages are much stickier and staying at a higher level, and the general level of inflation is coming down. So what does someone do who has extra cash? They've already paid for their food. They've already paid for their health insurance and their rent. They get on a plane and they go someplace. A matter of fact, I think the group that looks the most, that's the most empowered in this environment are seniors that have a pickup in their cost of living. And what are they likely to do? They're likely to go, on a river cruise gambling, or they're likely to go, on something where, something like, like I said, like a cruise. Where it's particularly well geared for them. And if you look at how the cruise lines have done this year, they've just been on fire. And I think that this is part of that theme.
Labour pressures. We've talked about that. You've mentioned it. So Labour feels like they have the power. The markets might be compromised. Home Depot, Walmart early this week. Home Depot basically warning that there's going to be some labour pressure that might hit margins. That was the take from a lot of analysts. John, are they the losers in your world?
Yeah, I mean, if you think about this the way an economist would describe it, is you have a certain amount of economic growth in dollars. And certain years, it goes to the owners of capital, and certain years, it goes to labor. For the last 25 years, the owners of capital, companies, have been the big winners, and labor has stagnated more. The next year or two, it's going to be the opposite. And so, this from a policy perspective, people have wanted the economy to rebalance so that the average American sees their own situation moving ahead in the same direction as the stock market. And it hasn't happened that much in the last 25 years. But in this environment, that's exactly what's happening. Labor is coming out ahead. And I haven't really heard policymakers talk about this as a win, but I think it probably is.
It would be a win if they talked about it, but they don't really talk about it that much. I think that's the objective, the ultimate objective. So, John, we live in a world where the economy might look good and the market might look bad. Is that the takeaway?
Yeah, I think it is, John, is that the corporations, first of all, in this environment where the consumer feels pretty good, you don't get a recession. So that's one of the real positives for the stock market since the beginning of October, is that the likelihood of a recession in the picture I paint is much lower. And if you don't have a recession, it's truly not bad for the stock market. On the other hand, corporate profits, the expectations for how they're going to do in 23 and 24 continue to fall. And it's not a revenue problem. It's not that people aren't spending. It's that corporations are getting squeezed on profit margins. And that's going to be the story. This earnings season, earnings are up over 5%, margins are down 9%. That's directionally what I think the rest of the year is going to look like. Sales good, profits weak, and people are going to be really confused about that, but it's all about wages.
So, John, right now in the S&P, 4,016, 4016. Your year end is 4050. Given the risks we've talked about, given the weightings of the S&P 500, each company is going to experience these themes in different ways. A risk skew to the downside?
You know, I mean, I think the overall market's probably going to be flattish. And it's really interesting how well the call is working out. You know, in the beginning of October, when we put out this 40-50 target, our expectation was the stock market would move very rapidly higher as inflation settled down a little bit, as recession risks eased. But that once we got into the beginning of this year or the middle of this year, that the upside was going to be capped. And I think that that's probably true. But there are winners. So we're talking about winners and losers. Defensive stocks, those that do the best when we go into recession. If you're not going into recession, you don't need to be in consumer staples or utility or healthcare. So I think that they're laggards, and they haven't done all that well, generally speaking. Consumer discretionary, even though the overall economy is sluggish, if the consumer feels better, those names do pretty well. And you were talking about the airlines, we're talking about cruise lines. Those do fine. Tech companies are really struggling, and that's kind of a somewhat different story. But I would love to be buying tech right now, but the earnings picture there is somewhat challenged, especially at the biggest tech companies.
And so many people have been doing just that so far year to date with big runs already. John, this was wonderful just to get a breakdown of your framework for thinking about this market. Jonathan Golub there of Credit Suisse. Year to date, the Nasdaq up by close to 11%, on the S&P 500 up close to 4.5%. Coming up, more cuts in tech and finance.
We know that there are structural things that have happened to the labor market that aren't going to be easily fixed. Now, on the one hand, that's good for consumers, but it's also not good for the consumers who end up losing their jobs because margins are getting pinched.
This time, it's Wells Fargo and Meta. That conversation up next.
This is Bloomberg The Open. I'm Lisa Mateo, live in the principal room. Coming up, Cliff Adness, AQR Capital Management CIO. That conversation at 10:30 a.m. Eastern, 3:30 p.m. in London. This is Bloomberg.
Margins are going to continue to be pressured by wage growth for a bit longer. And we know that there are structural things that have happened to the labor market that aren't going to be easily fixed. Now, on the one hand, that's good for consumers, but it's also not good for the consumers who end up losing their jobs because margins are getting pinched. I think at the end of the day, that's one thing the street is struggling to understand is what is the new normal in terms of labor.
So it's hard to get your hands around this. We had claims earlier this morning at 200,000, sub 200K. But just in a couple of industries, finance and tech, the layoffs keep piling up. Wells Fargo cutting more than 500 jobs in its mortgage unit, adding to the thousands of cuts from last year. In big tech, the Washington Post reporting in the last 24 hours that Meta plans to reduce and reorganize thousands of workers. Shanali Basak joins us now here in New York alongside Mandeep Singh. Mandeep, first to you, the story we're familiar with now in tech, more cuts.
Well, so and it's not surprising because tech companies have high fixed costs. I mean, if you keep aside the Uber, Lyft, and the ride-sharing companies, most of the times they have a very high operating leverage because, you know, in times when revenue growth is strong, the fixed cost model works quite well. The problem is when the revenue growth starts to taper down, which is the case, with all the consumer tech companies, the fixed costs become a problem because it shows up in the margin degradation. And that's why you see another round of cuts possibly at Meta. And I don't think it's good for, the morale or just retaining talent. So I do see as a problem when companies have multiple round of cuts.
Mandeep, given the excess hiring we saw in the pandemic, are we closer to the beginning of this or the end?
Well, so I would say we probably have a few quarters to go, simply because in the case of Meta, it looks like a structural problem. We saw that, with Apple changing its policies around privacy, that hurt their ad pricing. Now they're tinkering with a subscription model, charging creators for using the tools on the platform. And those structural issues take time to resolve. I mean, maybe Meta may not be able to get to that 20-25% top line growth level again. And that's when they have to think about how they can right-size the costs. And that's what they're doing here.
Sonali, in tech, it's thousands, tens of thousands. It's far more incremental with these banks. What are you seeing, Sonali?
It's drip by drip, John. And remember, some of this is because of slowing growth, slowing business at many of these firms. You saw that over at Goldman Sachs be part of the case after years of headcount increases. But remember, some of this you have to recognize is also strategy shifts as some of the market fundamentally changes. When you're looking at Wells Fargo and particularly, that's certainly the case. Because not only are the mortgage markets really hammered here, you also have this secular move from the mortgage markets away from the big banks and lending into other places instead. So when they're cutting jobs here, it's not just about boom and bust. It is about changes in the environment itself. The question here then becomes thousands last year, hundreds this year. Who else is yet to come? The mortgage market is a very clear space where there's a lot of pain. You saw those cuts at JP Morgan as well. But do those cuts become deeper elsewhere? It's a very close thing to watch after watching Bank of America announce hundreds as well after holding on for dear life for the last couple of weeks and trying to preserve those jobs. Does it get deeper?
It's incremental, but we're seeing it more and more. Sonali, thank you. Alongside Mandeep Singh, to the both of you, just fantastic. One name I wanted to pick out, Tesla. It's up in early trading by about 1% so far, last time I looked. Year to date, it's absolutely flying, up by 65%. The latest news from the company, the EV maker announcing it will set up its global engineering headquarters in Palo Alto. This coming after years of Elon Musk essentially bashing the state of California. Bloomberg's David Welch joins us now with more. David, what's the latest?
Yeah, so they've named California as their engineering center, which isn't really a huge surprise, except that Elon has been fighting with the state, criticizing the state. He moved the headquarters of the company to Austin, Texas, and has expanded the footprint there. But Tesla still has about 46,000 employees in California. And if you look at it, if you're trying to develop electric vehicles, you're trying to develop self-driving vehicle technology, the talent base is still in the Bay Area, Silicon Valley. So if Elon wants to continue developing all of these things, and he does, he's got to have an engineering base there because that's where the people live, and it's going to be tough to get them all to move to Austin. So I think this is about talent and about having an existing base already in the state.
David, do you think that story is changing, though? We hear that talent argument a lot, but ultimately, given the hybrid nature of working for so many people, particularly on the West Coast, is that changing at all?
It is, and Austin has a pretty good talent base itself for technology. But when you're looking at code writing, things like that, I think with this announcement, he's got, let's say, big footprint in each state. So people can work in Austin, people can work in California, they can collaborate virtually, they can fly back and forth. It's not a long flight. I think he's probably playing both ends of it here, which is a smart thing to do because you do have talent pools in both areas.
True. Good point, David. Thank you. Stock's up by about 0.7% now. The broader market, about 23 minutes into the session, is up 0.8 on the S&P and the Nasdaq, doing okay, better than okay, up 0.9% with a sector price action. Here's Abby.
Well, we have very strong action, not surprisingly, today, John, with that S&P 500 up for the first time in 5 days, and it has everything to do with Nvidia and big tech. Nvidia up 13%, the best day of the year. Technology, the best sector, up 1.76%. We have a few other sectors up about 1% or more. The only sector down, communication services. This as Netflix is down about 3% on a report that they are cutting subscription costs in many countries. As for the last month, well, because of the move that we're seeing higher for technology, despite rates going higher, discretionary and tech higher, utilities and energy lower, a little bit of a flip of last year.
The broader market higher. Abby, thank you for that. Up 0.9%. Your trading diary up next. Attempting to break the longest losing streak of the year so far in the S&P. Over the previous 4 days, we were down every single day to a total of about 3.9% into negative territory. We bounced back from that, up 0.9 on the S&P, on the Nasdaq, up by 1.3. That's the price action. Here's the trading diary. What you need to be looking for. Commerce Secretary Gina Raimondo speaking at noon Eastern Time. Fed speak from Bostic daily. Then Jefferson, Mester, Bullard, Collins, Waller, all speaking on Friday. Plus new home sales, PCE deflator, and income and spending numbers to round out the week. That rounds out this morning for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg TV.